to file those tax returns yourself. So we will get those set and through you. And then the last week, obviously, will just be the final. I would imagine they said that they are changing the final schedule to just a regular week, but I don't know. As many times they changed everything, you can't really trust what they're going to tell us. So we'll see what happens. If they keep it a regular week, then we'll just meet briefly on Monday to give you the information that you need. And then we can take the final Tuesday or Wednesday. It really doesn't matter to me. You guys can pretty much pick what you want to do, but maybe we'll just leave that window open. You can do it whatever day you want to, depending on what your other classes require. So if you go to your econ homepage and click on modules, we're to week 15. So you want to scroll down to module 15, which corresponds to week 15, which is what we're in. So you can see what we're going to cover today. And then tomorrow we'll go over the 2 games you're going to play. The 2 assignments, or 2 of the 3 assignments that you have are games. One is going to be a game in which you use fiscal policy to set the budget for the country. The other one is going to be a monetary policy game in which you try to keep the economy under control. Inflation doesn't rise too fast or unemployment doesn't go too high. So 2 of the 3 assignments will just be a game with that policy. So go ahead and go to your econ homepage and click on the modules and get to module 15. So still no Alexis, right? No Alma yet? No Christian? And no Aiden yet? All right, fair enough. Okay, so last sort of module that has content. Really, the tax returns are pretty self-explanatory in terms of what we'll be doing. But as I said yesterday, this week, we're going to take a look at fiscal policy, how the federal government tries to keep the economy stable. We'll look at monetary policy, which is how the Federal Reserve System tries to keep the economy stable. You need to be able to understand that the federal government, through the executive branch and the legislative branch, is the ones that use fiscal policy to stabilize the economy. The Federal Reserve System is the one that uses monetary policy to stabilize the economy. Be able to explain the similarities and the differences between each of those entities and monetary and fiscal policy. Understand the different tax types that we have, the debates about taxes that we have, the financial institutions, how those are protected through the FDIC by the federal government, and then be able to explain each tax type and who it might affect negatively or positively, so that when you hear these debates, as you get older, you can sort of choose which is best for you. So first thing I want to show you, actually, first 2 things I want to show you, deal with where your tax money is spent. And this is from the focus of the federal government, all right, not the state government, though I can show you an example of that. So here is just a little breakdown, and this is from the first decade of this century, in the 2000s. When we look at how our tax money is spent, and this is by the US government, 23 cents of every dollar was spent on Social Security. If you remember when at the beginning of this, at the semester, very early in the semester, we talked about Social Security. My generation, right, in people in their ages, really probably 40s, 50s, are paying for and have been putting in money to Social Security Fund for my parents' generation. Okay, all my grandparents are now dead. Your generation, the generation that comes after mine, you have, if you have been working, have been putting money in for my generation and your probably parents' generation, as well as your grandparents' generation. And so each generation, right, basically puts in so that when they reach retirement age, they can draw on that government retirement program. And that's what Social Security is. That's all it is. Health and Medicare is another 22 cents a dollar. So when you look at it, the federal government in the early 2000s is paying 45 cents of every dollar that they get from taxes on Social Security, health, and Medicare. Now remember the difference between Medicare and Medicaid. We talked about this, I think, in Module 3. Medicare is healthcare for those at retirement age, government-run healthcare. Medicaid is for those that are below what we consider the poverty level, and we help them with healthcare because they, in relation to the level of income in this country, are below. So we supplement their income basically by subsidizing some of their healthcare. 16 cents of every dollar is spent on national defense, so Vandenberg Air Force Base, naval stations, Army, Air Force, what have you. Income security is 14%. That is, or things like unemployment insurance. Paying the interest on the national debt is 10 cents of every dollar collected. Education and training is 4 cents. Transportation is 3 cents. So that is your interstate highway system. Federal money for dollars. Veterans benefits and services are 3 cents of every dollar taken by. Now, one of the things that you'll see, and you'll see this next week when we look at, say, a federal tax return, is the federal government puts this information out. And not a lot of people read this in their tax booklets. But if you wanted to know for the previous year, what money did the government bring in and what money did the government spend, it is put into your tax booklets. So this is the 2018 tax return, and it has the 2017 numbers in there. So there are 2 categories here. One is called income and one is called outlays. So the income here is tax money that you and I pay, your parents pay, everybody pays. The outlays are the money that the government spends. And when I say government, remember, we're talking about the federal government. So it is required by law that basically the first Monday in February every year, the President of the United States is required to submit in writing a budget proposal to Congress. Congress is the Senate, the upper house, the House of Representatives, the lower house, and that's required by law. The fiscal year for the government runs from October through September. So, right, remember some fiscal years run July through June. The government's fiscal year runs from October through September. So that's why, especially the last couple of years, you've always had these, right, government shutdowns in the time of the holidays, Thanksgiving, Christmas, Hanukkah, whatever it may be, because the budget year started in October. The government's going to run out of money in a month or two because they haven't approved a new budget. That's why these budget fights always seem to, these government shutdowns always seem to happen during this time of year. So that is why that happens. So when you look at these numbers in the federal tax booklet, as I said, are the previous budget's approved year. And so these are actual numbers. So you can see in 2017, which gets reported in 2018, right, because of the fiscal year running October, you can see that Social Security, Medicare, unemployment, and other retirement taxes was 29 cents of every dollar collected by the federal government that year. So not 45 cents, you can see it's gone down. Personal income taxes is 4 basically 40 cents, right? 40%. Borrowing to cover the deficit is up 7 cents a dollar to 17 cents a dollar. Corporate income taxes is now 7% of what the government brings in. And then excise, customs, estate, gift, and miscellaneous tax is also 7%. An excise tax is a tax on people that use specific goods. And we'll talk about that more specifically in a couple of minutes. Now, your outlays, these are where your government spends the money again. 41% on Social Security, Medicare, and other retirement. That's down 4 cents a dollar from the early 2000s. Law enforcement and general government costs 2 cents on every dollar. National interest on the debt down 4 cents to 6 cents on the dollar. Physical, human, and community development, 8 cents on the dollar. Social programs, 22 cents on the dollar. National defense, veterans, and foreign affairs up 4 cents, right? And Trump had been in office, and that's one of the things that he said was, I'm going to increase military spending. So these reports come in, and I just want you to know that as a taxpayer, you're able to look at that and see that where your money's going, where it's been spent, how it's being used. And you can see that every year. Now, the state of California has the same thing. When you do your state taxes, there is a section in the state tax booklet that has the same thing. Last year, this was the budget. This is how the state brought in the money. This is how the state spent the money. And you can sort of see where it's at so that you can make informed decisions. Next, I want to talk a little bit about financial institutions. So financial institutions are your banks, your savings and loans, your credit unions. Credit unions are probably the second most popular financial institution in the United States. So what role does inflation play in our economic system? What is the role of our financial institutions in our economic system? And then understand how taxes affect those in the United States, even if you are not paying them. So our biggest problem, let me reset this real quick. Our biggest worry or problem in our economic system is inflation. And inflation happens generally when there have been a number of quarters or a number of years of really fast economic growth. And what you have happen and why this is a problem is when things are going extremely well and people are making lots of money, they generally spend lots of money. And the economy can't keep up in the production of goods and services because after a while, right, so only so many people can buy cars, only so many people can buy houses, you're going to run out of goods. And when you run out of goods, that creates a demand. Demand increases the prices that we know, right, from our module 4 or our unit 4 basically talk about demand. And you have increasing prices with less money, and that is inflation. And what it does is it causes speculation. People will start buying things, and you've seen this firsthand, right? If you went into Costco this weekend, they have the whiteboard back, right? These are the items that we have in stock. These are the items we're out of stock on again, right? So we know that crazy things cause speculation. And when that happens, people buy up large amounts of that, right? They're hoarding the toilet paper maybe again, the wipes, the disinfectants, whatever it might be, right? So that causes a problem. Debtors during an inflationary time period who borrowed money, basically because they're paying for more for other goods and services, people that owe loans or mortgages or car payments now have less money to spend on that. Retired people who are on a fixed income, when prices go up, their income doesn't go up. It hurts them as well. And then it also hurts the people who lend the money. With people spending more on other goods and services, banks don't do as well. Banks don't lend out as much money because people can't afford that, and the economy starts to shrink. So inflation really, in your lifetime, inflation in my lifetime, early 70s was way out of control, but I was little, didn't remember that. The very late, 89 through 91 probably, we had an inflationary time period during the Bush administration. Part of what propelled Clinton to his victory was what was going on with the economy. It hadn't recovered in time for the election. Inflation has for these periods of time really been the economic sort of popping of the balloon. The housing market, when that burst, we had an inflationary time period then. And so if we can keep inflation under control, we can keep the economy good, is basically the philosophy. And so one of the things that we monitor inflation by is what's called the Consumer Price Index. And so the Consumer Price Index is a very simple idea. And it obviously is different from state to state, city to city, right? You could go to rural parts of California and it would cost less than it would, say, in San Jose or the Silicon Valley, right? The Consumer Price Index is a number that is put out every month by the U.S. Department of Treasury. And basically, it's a number that gives the average level of prices for an urban family to feed, to house, and to clothe themselves for 1 month. So what is the average family paying a month to provide the necessities? If that Consumer Price Index is going up, it sets off a trigger warning that we may be headed for an inflationary time period. And so then what will happen is they will take the new Consumer Price Index, the most recent one, using this formula, subtracting that from the earlier price index, dividing it by the earlier price index, meaning the month before, and that gives us our rate of inflation. If the rate of inflation starts to go up month after month after month using this formula, then the federal government and the Federal Reserve System that we'll discuss later are going to step in and try to stop the economy from spiraling out of control. We also, to a lesser concern, depending on what's going on, worry about deflation. Deflation affects businesses, where inflation affects consumers more, but deflation at a large level could affect businesses. Businesses could lay off people. Laying off people would have less people to produce goods and services, and you can see the problem there in terms of shrinking the economy. So these are the concerns in our economic system, and we have many tools to try to address that. The first thing is the setup of our financial institutions. So in the United States, and we talked about this in the very first couple of modules, right? Money is what drives our system. And there are three functions of money. We've talked about this before, right? Money is a medium of exchange. If you have a dollar bill, you can take that dollar bill if you're on campus, go to a vending machine and get out a dollar for a drink. All right, get up a dollar for a drink. We can use money to exchange for goods and services we want. Money can also be a measure of value. If you look through the ads, right, there is a dollar sign on most goods and services in terms of what that would cost you. So we use money as a value, and we also use money as a store of value. If I took a dollar out of my wallet, that dollar is rated or valued at a dollar. If I had taken that dollar out when I was 10 years old, it would have been rated at a dollar. If I take that dollar out when I'm 60 years old, it's going to be rated as a dollar. So it doesn't matter, right, the time period. We know that a dollar bill is going to be a dollar bill until it is no longer, right, this country. So there are three things that money do in our economic system. We use it to exchange, we use it to put a value on a good or service, and we also can use it as a store of value. We could put money in a bank and know that if we deposit $10,000 this year, I can pull that money out next year, and all that money is still going to be guaranteed by the government as $10,000. Any questions on that? All right, just a second here. We got some sort of rogue. Sorry, somebody trying to crash our Zoom here, apparently. Not on our watch. Okay, So all financial institutions, whether banks, whether they're credit unions, whether they're savings and loans, are part of what's called the Federal Reserve System. And the Federal Reserve System is basically the banking system of the United States. There is a central bank where the board of directors is or meets, basically employed, and that's in Washington, D.C. And then the rest of the country is divided up into 12 districts. Basically, if you were to draw a line from Idaho down through Utah, Arizona, go west, including Alaska and Hawaii, that is the San Francisco district. The chairperson of the Federal Reserve System, the chair of the Fed, is Jerome Powell. Last one was Janet Yellen. Janet Yellen was one of the people mentioned in the Biden administration. So that's what her claim to fame was. She used to be the chair of the Federal Reserve System. So the function of the Fed, the function of the Federal Reserve System, the banking system of the United States, is to be the bank for all of the banks in the United States. It is the lender of last resort for all banks in the United States. It's the national bank of the federal government. It creates and oversees day-to-day operations of check clearing, as well as the buying of securities. So we'll talk about this a little bit. The check clearing process, when you have a checking account and you write a check, if you go into a business and you write a check, that business will take that check at the end of the business day and deposit it with their bank. Their bank, because we're in the San Francisco district, will basically send the information, the routing number and the account number on that check to the district bank in San Francisco. The routing number alerts the district bank what financial institution you bank at. They use your account number to draw the funds to the district bank. The district bank will then take those funds and deposit those funds with the bank account of the business. So this process used to take up to a week when I was very little. When I went through college and even young, as a young adult, it would take 2 or 3 days. Now with computers, electronically, it is done rather very quickly, usually less than a 24-hour period turnaround for that. So that is sort of the function of the Fed and what they do. And as I said, it is the bank of the government. Now, as you know, with the Great Depression, and as juniors last year, you guys looked at this in U.S. history, one of the reasons the Great Depression was so bad was not only was the economy doing poorly, but then the banking system failed. And so one of the things that was set up out of the Great Depression was this idea that we should, as a country, become involved in the economy in terms of stabilization. And so one of the things that the federal government did to reinstill faith in the banking system and the Federal Reserve System, which was set up, I think, under Wilson, was to guarantee your account. So the Federal Deposit Insurance Corporation was created, FDIC. In fact, there hasn't been a bank I've gone into or financial institution I've gone into in 40 years where I haven't seen this sticker on the doors and inside. And basically, FDIC is an agency funded by the government, overseen by the government, that insures deposits of individuals and banks up to $250,000 in the event of another bank failure. So remember in the Great Depression, right? One person heard, right, that a bank was going to run out of money, that there was a run on the bank, and that causes more and more people. Similar to, right, when we're on campus and you see a couple of people running, you assume it's a fight, so then everybody starts running to go see the fight. And it's sort of similar there in terms of what happened in the Great Depression. So you have regular banks, right? So Mechanics Bank, Rabobank, Chase Bank, whatever bank that you may have. We have another financial institution, which is called a savings and loan. They're more popular in the Midwest and South, really, than the West. They haven't been very popular in 30 years out here. But that's a bank that is used for savings accounts and home mortgages. Mutual savings is very similar to a savings and loan, except they don't generally loan out as much as a savings and loan. The last savings and loan scandal was probably the early 80s, 83, 84. There was a gentleman named Charles Keating. He had a bunch of savings and loan banks from Texas all the way to Arizona. In fact, my grandfather had money in one of those savings and loans in Scottsdale, and basically his savings and loan failed. It was a scheme. It was sort of similar to a Ponzi scheme. He was pulling money out of the savings and loan to do a bunch of illegal activities. And the FDIC at that time was only insured up to $100,000 an account, but my grandfather would have lost money if he had not done an FDIC insured savings and loan. And so these financial institutions, you always want to make sure that you're depositing your money in an FDIC insured financial institution, because the federal government will now insure your money up to $250,000. Credit union, there's a number of credit unions in this area: Santa Barbara County Employees Credit Union, Teachers Credit Union, Vandenberg Air Force Base Credit Union. But a credit union is similar to like a Costco or a Sam's Club. Basically, you are a member of a group, or you pay to be a member of a group, and then you form together to get better interest rates, to get better deals. And that is what a credit union is in terms of a financial institution. Questions for me on that? Okay. So next, let's take a look at types of taxes. Now, each state in the United States has a different way that they tax, whether it be sales tax, income taxes. You know, there's no personal income tax in states like Texas, Florida, Nevada. That's why you have a number of retired people go there, because their retirements aren't taxed. But these taxes generally are, and what we're going to look at, are based on federal government ideals. So just as a reminder, a tax is charged, right, by a government entity on people or property for public purposes. Now, the functions of taxes is to pay for public goods. We talked about this in earlier modules, right? A public good is a good that people would not provide on their own, or are not provided because they wouldn't offer a profit motive for people to provide that. So taxes are used to pay for public goods, right? Rigetti High School would be an example of that. Your interstate highway system would be an example of that. Correct problems of negative externalities. Hurricane Katrina comes through and wipes out New Orleans. FEMA, a government agency, steps in, helps people with temporary housing, helps them rebuild with money for their houses, helps them negotiate new loans, things like that. That is what taxes for correcting negative externalities would be an example. Here in California, we had that same example with the fires up north, right, where people, entire cities, entire subdivisions get burned down. Taxes help with that negative externality. Taxes are also used to stabilize the economy, to keep inflation in check. We do not want, in a country, if there were no taxes at all, there'd be too much money chasing too few goods. So taxes act as a stabilizing force in our economic system. As we talked about, federal tax revenues, the money that they bring in, come from individual income tax, Social Security tax from people that work, corporate taxes, which is taxes on their corporate profits, and then excise taxes. Excise taxes are taxes for only goods that are used. So your best example of that at the federal level, let me give you an example at the federal level. We have one of the largest ports in the world in Los Angeles, right, at San Pedro. So the Port of Los Angeles, an unbelievable amount of goods and services are brought in. Each ship that docks in that port pays a tax. They pay a tax to dock. They generally pay a tax to unload their goods. That is an excise tax. If you do not have a ship, you don't dock there, you don't pay the tax. So that would be an example of tax revenue from an excise tax. As we've said, the government takes that money, spends it on income and Social Security, health and Medicare, interest on the national debt, national defense, education, and training. similar to what we showed you with this, right? Every year the government brings in money from these sources. That's their income. Their outlays are what they spend, right? Outlays are what they spend. So when you look at it, generally in the nationwide debate, and you had this to an extent, right, in this last presidential cycle, you had a debate where there was the benefit principle of taxation versus the ability to pay taxation, right? You had Biden saying those who can best afford to pay should pay, right? He is echoing the thought of a group of people that said, look, those who make the most money should pay the most in taxes, where you have someone like Trump who said basically the benefit principle of taxation, those who benefit should pay, at a much smaller view of who should pay. So these are debates that have been taking place for 40 years that I can remember. You have different types of taxes that fit into each of those philosophies. So you have a progressive tax, right? A tax that takes a higher percentage of incomes and a smaller from lower incomes. This would be something that those that support Biden would want, right? We're going to take more taxes from higher incomes, smaller taxes from smaller incomes, and he's talked about that, right? The $400,000, if you make less than $400,000, your taxes are going to go down. You make more than that, your taxes are going to go up. So that's a progressive tax supporter. A regressive tax is a tax that takes a larger percent from lower incomes and a smaller tax from higher incomes. And so regressive taxes are seen to hurt the poor or the low income. You have those that argue for proportional tax. I believe it was Steve Forbes in the 80s was a Republican running for president, and he supported this idea of a flat tax. Get rid of the Internal Revenue Service and just say, look, you are going to pay 10% of every dollar you make to the federal government, and that's the end of it. We're not going to get into these deductions and what's allowed, what's not allowed, et cetera. A direct tax is a tax paid by the person who the tax is levied against. So, for example, when you buy a vehicle, there is a tax on that, sales tax on that. Or let's say you buy tires for your vehicle. There are basically California environmental impact fees on those tires. If you don't buy tires, you don't pay that tax. So that tax is direct for only people that buy it. An indirect tax is a tax paid by someone other than who the tax is levied against. Your example there would be, your best example would be sales tax, right? When you go into a store, you pay, in addition to the sales price, you generally pay a sales tax. But that sales tax is really a tax from the state government or the city or the county government that's collected by the business on behalf of those entities. So in essence, it's an indirect tax. The same thing with any gas station you go to, right? There are a number of different taxes on the gas station. And those taxes, whether it be the federal tax on gas, the state tax on gas, the local tax on gas, the sales tax on gas, that is an indirect tax collected by somebody else. Corporate income taxes, we've talked about. Corporate income tax, a tax on the earnings of corporations. The excise tax, as I said, is a tax levied only on a specific item. Generally, things like alcohol, gasoline have an excise tax. The city of Seattle and Washington, they put a tax on liquor about 2 years ago. Only those people that buy liquor, right, would pay that tax. They have, I think it goes up to 18% on the type of liquor it is in Seattle. And that was a big story 2 years ago in terms of taxes. Property tax, a tax levied on real estate. Property taxes generally are funneled to the county level, some to the city level, but basically are redistributed, and that's how public schools are funded for the most part. And then a Social Security tax, a tax that provides disability and retirement benefits for most working people, right? Most working people. Questions on me, or questions for me on that? Okay. So it is 10:56. Let's take a 4-minute break, and we'll come back at 11 and finish what we need to do, and we'll be done. All right. So to finish up, we've looked at financial institutions, we've looked at taxes, we've looked at sort of the consumer price index that alerts us to maybe an inflationary, possibly a deflationary time period. What does the government do to try to keep the economy stable? And there's two different mechanisms working in conjunction, but separately from each other, to help keep the economy in a stable economic period. And so basically you have two parts. On the left, you have the federal government, and the federal government with the executive branch, the president is the one that proposes the budget. The legislative branch is the one that approves the budget. That is fiscal policy. On the right, you have the Federal Reserve System, the 12 district banks and the National Bank in Washington, D.C., that uses monetary policy to stabilize the economy. So the federal government, through spending, through taxation, and sometimes borrowing from the Federal Reserve System, can use fiscal policy to help keep the economy in balance. The Federal Reserve System can use interest rates, buying and selling daily securities, or lending money to banks in a higher amount or lower amount to stabilize the economy. So fiscal policy and monetary policy are both utilized to stabilize the economy through their actions. And so, as I said, what you have in this country, and let me reset this so you can see this for sure, is a system that all banks are within a district. As I said earlier, if you draw a line basically from Idaho down through Utah, Arizona, that includes Hawaii, Alaska, go west, that's the 12th district. All the banks, all the savings and loans, all the credit unions, and all of these states, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, all belong to the 12th district. Any check that's written in any of those states goes to the district bank in San Francisco and it's processed there. As I said, Washington, D.C. is where the star's at here. This is your Federal Reserve System, the national bank. And you can see different areas of the country have different districts, and those district banks are located in large cities. So Richmond, Virginia goes all the way back to the old Confederacy. That's why it's there. But you have Boston, New York, Philadelphia, Cleveland, Chicago, Minneapolis, St. Louis, Atlanta, Dallas, and San Francisco. So what does the Federal Reserve System do? And let me bring this up.
Money. It certainly does make the world go round. And the reason it's able to do so is that we trust these little pieces of paper. That's all it is, just a piece of paper. But around the globe, there is no piece of paper that inspires more confidence. Take this one, for example. We typically call it a $20 bill. But officially, it is a Federal Reserve note. And every Federal Reserve note that you spend or receive is part of a complex organization known as the Federal Reserve System. Hello, I'm Charles Osgood. The Federal Reserve System, or the Fed as it's commonly called, is the central bank of the United States. Since its creation in 1913, the Fed's essential mission has remained unchanged: to establish and maintain the public's confidence in our nation's monetary and banking system. Over time, that original mission has expanded to include responsibility for providing a stable, healthy, and growing economy. But the confidence that exists today did not exist during much of our country's early history. Throughout much of the 1800s, almost any organization that wanted could print its own money. As a result, many states, banks, and even one New York druggist did just that. In fact, at one time, there were over 30,000 different varieties of currency in circulation. Imagine the confusion. Not only were there multitudes of currencies, some were redeemable in gold and silver, others were backed by bonds issued by regional governments. It was not unusual for people to lose faith both in the value of their currency and in the entire financial system. With many people trying to withdraw their deposits at once, sometimes the banks didn't have enough money on hand to pay their depositors. Then, when the funds ran out, the banks suspended payment temporarily, and some even closed. People lost their entire savings. Sometimes regional economies suffered. Obviously, something had to be done. And in 1913, something was. In that year, President Woodrow Wilson signed into effect the Federal Reserve Act. This act created the Federal Reserve System to provide a safer and more stable monetary and banking system. The Fed was designed to be a decentralized central bank. The Fed consists of two primary parts: a board of governors, which guides most of the policies of the Fed, and 12 regional Federal Reserve banks and their branches, which are the operating arms that provide services to banks and the public in their regions. The Fed has a unique public-private structure that operates independently within the government, but not independent of it. The Board of Governors, appointed by the President and confirmed by the Senate, represents the public sector or governmental side of the Fed. The 12 reserve banks and the local citizens on their boards of directors represent the private sector. This structure provides accountability while avoiding centralized governmental control of banking and monetary policy. The regional reserve banks work with the Board of Governors to establish and implement monetary policy for the nation. They provide a variety of financial services, and they're responsible for supervision of banks and bank holding companies. Of course, all three roles are designed to fulfill the Fed's main goal: a stable economy characterized by higher employment and production, steady growth, and overall stable prices. No small feat. Let's take a look to see how the Fed accomplishes this. The foundation of the Fed rests upon developing and implementing a sound monetary policy for our country, a monetary policy whose primary focus is on price stability. But how does the Fed influence price stability? A large part of the answer occurs right here, this room. Because you see, it's here that members of the Federal Open Market Committee meet to make decisions that influence financial markets both in the United States and around the world. These decisions affect the amount of money and credit that's available for our economy. All right, you may be asking, well, what does the supply of money have to do with price stability? Why don't we see? As the supply of money grows and more money becomes available, the demand for goods also grows. When the supply of money grows faster than the production of goods and services, prices usually begin to rise. This can lead to inflation. On the other hand, if the supply of money decreases, the demand for goods also decreases. In the extreme case, prices could fall, and manufacturers and businesses could begin producing fewer goods. We refer to this situation as recession. The goal of the Fed's monetary policy is to stabilize the nation's supply of money and credit, and to prevent both inflation and recession. The primary way the Fed does this is by buying and selling government securities. Securities in the form of treasury bills and bonds represent investments in the United States government. And again, it is in this room that the Federal Open Market Committee sets guidelines for the sale and purchase of these securities on the open market. If the Fed determines that there is too much money in circulation, a situation that could lead to inflation, it will sell securities. This takes excess money out of circulation and helps to stabilize the economy. Conversely, if there is too little money in circulation, which could lead to a recession, the Fed buys securities. This puts money into circulation and again stabilizes the economy. Every business day, the Fed gathers information to determine just how much money needs to be added or subtracted from the nation's money supply. These traders then make the actual sales or purchases of securities that affect the supply. The result, a stable economy characterized by higher employment and production, steady growth, and overall stable prices. Congress establishes rules that govern the supervision and regulation of banks that operate in the United States. The main purpose? To promote the safety and soundness of banks, which in turn enhances the public's confidence in the banking and financial system. And it is the Fed, together with other bank supervisory agencies, that has the responsibility of making sure these rules are followed. In its supervisory role, the Fed monitors banks and bank holding companies, that is, companies that own or control one or more banks, and the U.S. operations of foreign banks. Federal examiners look at such items as financial records, the potential risk of the bank's investments, and they also check to see if the bank is following applicable laws. This supervision may be done either off-site using automated screening tools or on the bank's premises. In either case, the bank receives a rating. If a potential problem is discovered, the Fed will require that the bank take corrective action. But whether in its supervisory role or in its regulatory role, the Fed's aim is, once again, to maintain a stable and healthy banking system capable of supporting economic growth. From its beginning, the Fed has provided a number of services to our country's financial institutions. The Fed plays a vital role in the nation's payments system, that is, transferring funds or payments from one bank to another. This is done either as cash or checks and electronic transfers. Because of this role, the Fed is often referred to as the banker's bank. One of its roles is to act as the fiscal agent, or as the bank for the United States, maintains the U.S. Treasury's accounts, pays checks drawn on the Treasury, facilitates the collection of federal taxes, and is responsible for issuing, servicing, and redeeming Treasury securities. Have you ever thought about how much currency is actually in circulation? Believe me, it's a lot. Almost $500 billion, including the amount of our currency used in other countries. And it's up to the Fed to make sure that there's always enough money in circulation. This means issuing currency and coin to banks and working with banks to ensure that the currency that is in circulation is genuine and in good condition. The Fed transfers funds from bank to bank in the form of checks and electronic payments. When you write a check drawn on your bank account, the business receiving the check will then deposit it in their bank. But the check by itself has no real value. In order to have value, the funds from your bank have to be transferred to the bank receiving your check for deposit. The transfer of the value from one bank's account to the other bank's account is called settlement. 24 hours a day, 6 days a week, the Fed is busy clearing checks. The Federal Reserve System handles over 1/3 of all the checks that are cleared in the country. Checks may be scanned for important information that the bank requests. The Fed provides two types of these services. The transfer of funds service is used to move large monetary balances between nearly 8,000 institutions. The Automated Clearinghouse, or ACH service, is used to move smaller and recurring financial transactions, like monthly bills. Instead of having to write a check to the mortgage or insurance company, for example, the proper amount from your account is electronically deducted and then added to the account designated by the mortgage or insurance company. Many businesses use direct deposit for their payroll payments to employees. The federal government makes many payments through direct deposit, including those to Social Security recipients and military personnel. Monetary policy, banking supervision, and financial services. Once again, these are the three primary responsibilities of the Fed. Responsibilities that determine how the Fed helps to establish a strong economy. From 1913 until today, the purpose of the Fed has remained unchanged: to instill confidence in our monetary and economic system. But as the economy and financial system have evolved, and new laws and practices have come about, the way these goals are achieved has changed dramatically. Today, the Fed clears over 20 billion checks a year. Can you imagine clearing them like this? Seems almost impossible. But with electronic scanners and automated equipment, the process is not only faster and more accurate, it's also less costly, safer. Today, the Fed is continuing to develop new and more efficient ways of conducting business, ways that depend on the use of evolving technologies. Here, for example, the Fed uses an advanced data communications network and the latest data processing systems to handle electronic payments. Well, as you've seen, the Fed has been around for a long time. During that time, a lot of things have changed. Things will continue to change. But as you've also seen, the Fed adapts to the times, does what's necessary to foster a healthy, growing economy. Emerging democracies from around the world use the Fed as a model to help them develop their own monetary policy, to provide for price stability, economic growth, better living standards for their citizens. Because when it comes right down to it, the real purpose of the Fed is to provide trust in our nation's money. This requires price stability, the foundation for a stable but vibrant and growing economy. To keep prices steady, as we've mentioned already, keep jobs and production both coming, the job of the Fed, all's done and said, is to keep the economy humming. I'm Charles Osborne. Thanks for watching.
So that's the day-to-day process of the Fed and what it does. The Fed, as I said, is in charge of monetary policy. The federal government is in charge of fiscal policy. And so there's a couple of things here. If you want to get more in depth on that than the sheet that I showed you, you can look at each of these items. So this will describe fiscal policy, how the government stabilizes the economy via the taxing, spending, and borrowing. These presentations here, monetary policy of the Federal Reserve System in terms of the day-to-day selling of securities, the raising, lowering, or keeping interest rates the same, and then the lending, how much they lend to each of the banks. And then this is a short presentation on inflation and what that means to you. Tomorrow, as I said, we'll take a look at these two games. So basically your two assignments outside of the unit test are going to be games. The fiscal ship game I'll go over with you will be a game in which you'll make fiscal policy decisions for the country's budget of the United States. You'll set priorities on what you want to fund and what you want to defund. The second game is you controlling the Federal Reserve Fed rate to control inflation and employment, or the unemployment rate. And then last would be the last unit test for the semester. And then, as I said, the week before finals, we'll show you how to do a federal tax return and a state tax return. So that's what we will cover tomorrow in class. Period 2 on Wednesdays is 10:10. So we will see you then. Have a great rest of the day. Have fun.
Bye, Mr. Grock. Thank you.
Welcome. Take care.